Welcome back to the Talking Hedge. I'm Josh Kincaid, and this is a cannabis business podcast. Massachusetts-based Curaleaf, a vertically integrated multi-state operator, acquired California's Eureka Holdings for $30 million. Eureka operates a cultivation facility and is developing 3 dispensaries in the Golden State. The deal's worth $30.5 million, with $10 million paid in cash and the balance in stock, and the amount could potentially increase based on future performance. One of the top 3 investment trends we're seeing this year is multi-state operators, data, and then finally consumption lounges. So this at least covers one of those. So here are 4 pillars in order to become a multi-state operator. All business opportunities come with a certain amount of risk, but it's particularly important for those in the cannabis space to be aware of the potential hazards. Any cannabis business seeking to expand into multiple states must do it correctly, and that requires paying attention to building the foundation and business structure for that growth. Public perception about cannabis is rapidly changing. So in April 20th of 2017, there's a national poll that found that 94% of voters supported allowing adults to legally use cannabis for medical purposes if their doctors prescribed it. The same poll found that 60% of voters believe in the use of cannabis should be made legal in the US. Currently, there's 33 states and the District of Columbia, Guam, Puerto Rico allow for medical marijuana and or adult use recreational cannabis, meaning that a majority of Canadians now live in states that allow legal access to cannabis. So this changing time has created an environment where businesses that were first able to establish themselves in the early cannabis markets are now looking to expand into other states, raising the potential for significant growth as these multi-state operators increase their footprint into the nascent industry. Number 1, state-by-state licensing. The foundation requirement for any multi-state operator is to obtain the state license where you intend to operate. Each state has adopted its own regulatory and licensing scheme, and this leads to a wide variation between states, so imperative to know the details. Target a state or states where you can try to obtain a license and research the state's residency and ownership requirements. Proactively anticipate which states are considering or will soon consider adopting a cannabis regulatory scheme and prepare accordingly. Know what's required to secure a license and whether a state has an open or closed market approach, offers limited license, or imposes a regulatory structure where only a few licenses are issued. Understand each state's requirement for demonstrating available financial resources, as this can sometimes be prohibitive. Most importantly, retain an experienced cannabis regulatory and compliance attorney. This service will prove invaluable. Number 2, getting the property. Expanding into another state requires finding and securing appropriate and qualified real estate property on which to locate your cannabis business. For each state's regulatory restrictions on location, land use policies, and local zoning can make it challenging to find a location that works, both for the business and for the regulators. So negotiate the purchase or lease of real property for a cannabis business. It can be complex, time-consuming, and if not properly handled, carries unnecessary risk and expense. Every property has a history, and that property can be fatal for your ambitions. As such, you'll want to work with an experienced real estate attorney who can alert you to encumbrances, liens, easements, restrictive covenants, environmental contamination, and other factors that should inform your decisions to purchase or not purchase a property. Even leasing a property in the cannabis industry is complex. Cannabis leases are unique, so simply defaulting to a standard lease form can create problems. State regulators typically examine each proposed lease or sublease as a prerequisite to granting a license, making sure your lease addresses not only the standard business terms, but also is written so that it contains custom cannabis-specific provisions, requires not only a real property attorney, but one who's familiar with the state's marijuana laws and regulations. 3, the appropriate business structure. An appropriate business that's flexible and adaptive is important as a cannabis business expands into multiple states. So a corporation or limited liability is formed and licensed in one state will most certainly not be qualified to hold a license in another state. So at a minimum, a multi-state operator is going to have 2 or more licenses in 2 or more states. So establishing separate entities for each section of a multi-state operator provides certain protections, such as preventing the whole structure from collapsing for any reason one fails. So with proper design, a multi-state operator can utilize an overreaching corporate structure that covers separate licensed entities, thereby allocating risk among different subsidiaries. So for example, in states that allow vertical integration, owners may choose to form a separate legal entity for both the grow and the retail operations, and then different legal entities for trademarks, branding and licensing, for ownership or leasing of real property, and even for ancillary cannabis products should also be considered. So the assistance of legal counsel with expertise in multi-state operating law, tax, corporate formation, and structure is critical. Correct structuring at the outset is wiser, cheaper, and easier than fixing it after the fact. 4, access to capital. As cannabis businesses expand into multiple states, access to capital becomes a key business consideration. In some instances, a state's licensing regulations may require the business applying for the license demonstrate substantial financial resources. Capital to build out facilities and proper operations become critical. At this point, most businesses begin thinking about capital requirements from investors. A business can raise capital by taking on debt, otherwise borrowing money, or selling equity, which is ownership in the company. Moreover, there's areas in which debt and equity overlap. For instance, a company that could offer a convertible promissory note at the holder can then later convert that into equity ownership. Once a business begins accepting money from outside investors, a whole host of security and financial regulations become important. This is particularly true if your investors are from multiple states. In addition to required Security and Exchange Commission filings, each state has its own regulations and filing requirements. Consider also that not all investors are equally desirable. Understanding the rules about taking money from accredited versus non-accredited investors prior to accepting the investment can help you avoid violations, penalties, and delays. Offering and selling securities, including debt, is a commonplace business practice. You should solicit advice and guidance from a trusted attorney experienced in securities finance. We're going to roll this one up. I'm Josh Kincaid. This is The Talking Hedge, and I'm out.